Every point of sale system and on planet Earth, they all give you gross margin, right? What you sold in relation to the cost of the item that you sold it to. But cash margin looks at the net change in your bank account, okay? Think of it this way. A customer comes into your store and they buy something for $100 and you paid the vendor $50 for that item. Now, every point of sale system on planet Earth will say the gross margin is 50%, and that's correct. But what if you only sold one of those items and yet you bought 30 from the vendor? From a cash margin perspective, you would be upside down, $1,450. So the concept of cash margin is what I sold at retail minus what I received at cost. Okay, that's the net change in cash. Now, if your cash margin as a percentage is close to your gross margin, then you're doing great. You're doing what you should be doing. If your cash margin is lower than your gross margin, it means that you overbought. It means that you've spent more on inventory and you're not getting your cash out of that. If your cash margin, on the other hand, is higher, it means you're selling off old inventory. Now, sometimes that's a good thing. You want to sell off old inventory if you got too much of it, but if you do too much of it, that means that they're buying last year's goods, and imagine how much sales you could get if they were buying current, fresh, wonderful inventory. Okay? Take a look at the math examples again and again about cash margin so you can think about that as you think about your inventory and your sales and your profitability.